Welcome to the Physician's Guide to Financial Wellness, the podcast dedicated to helping physicians in Michigan turn their professional success into financial success while enjoying life along the way. And now, here are your hosts, Andrew Mushbaugh and Trent DeBruin.
Hi, everyone, and welcome to another episode of the Physician's Guide to Financial Wellness. This is Trent DeBruin, and I'm joined, as always, by my co-host, Andrew Mushbaugh. And today we're going to talk about the difference between tax preparation and tax planning. So it's that time of year where we're headed into tax season, and maybe you're even one of those overachievers who's already filed your tax return. But over the next couple of months, taxes will be on more and more people's minds. So we wanted to spend some time on the topic. And the reason why is because there's often a misconception or just a lack of awareness about the difference between tax preparation and tax planning. So in this episode, we're going to explain the two and help you understand how to think about each and what to focus on. So Andrew, we're talking about the difference between planning and preparation. And would you say it's kind of like Michigan football and basketball each year, where you're planning on them to win the national championship, but at the same time preparing for it not to happen?
That's a pretty good comparison there, but it's more like hoping and preparing on repeat.
Well, we definitely have that in common with our teams. So to start out, why don't you give an overview of tax preparation?
Sure, but you sure you don't want me to start with the process of how I prepare for Michigan to let me down?
I mean, I'm sure everyone would really appreciate that, but we can just dive into tax prep.
All right, point taken. I'll stick with the tax preparation. And the key difference to keep in mind between tax planning and tax preparation is that tax planning is proactive and planning ahead, while tax preparation is reactive based on what's already happened. Tax preparation is the process of actually preparing and filing your tax return each year. So what you or your accountant are doing is gathering all the information about what happened with your finances in the prior year and reporting that to the IRS. No more, no less. This includes gathering tax forms related to your income, whether it's from employment, investments, or other sources such as a business or partnership, as well as your expenses and tax deductions, things like mortgage interest, property taxes, charitable contributions, and information about your dependents. What you do is report all this information on your tax return, and based on that information, and potentially with a little anxiety waiting for that final number, you find out how much you owed in taxes that year. This number is referred to as your tax liability and is calculated the same for each person following the same tax code. And it's important to note that your tax liability for the year is different than the figure most people care about, which is, will you get a refund or owe additional money in taxes? As I mentioned, your tax liability is what it is. But to find out if you'll receive a refund or if you owe taxes, you simply compare your tax liability to how much you paid in taxes throughout the year. And the amount you paid in taxes throughout the year is based on the combination of tax withholdings from your paycheck, quarterly estimated payments, or a combination of the two. There are some nuances as it pertains to potential tax penalties with the way you pay taxes throughout the year, but I'll avoid going too far in the weeds here, and for the purposes of our discussions today, you can think about quarterly estimated payments and tax withholdings as the same thing, which is the amount of money you pay in taxes throughout the year. If you paid more in taxes throughout the year than what your tax liability ends up being, you receive money back from the government in the form of a tax refund. On the flip side, if your tax liability for the year ends up being more than what you paid in during the year, then you'll owe additional money or taxes when you file your tax return. Now, this is often where confusion comes into play, and people often assume they did a quote-unquote good job with their taxes if they get a refund, or did a bad job with their taxes if they owe money. However, that's not the case. Like I mentioned, the amount you owe or will receive back from the government is simply the difference between what you paid in taxes throughout the year and what your final tax liability ends up being. So getting a refund or owing taxes really comes down to the timing of when you pay those taxes. We'll touch on some of the things you can do to manage your tax refund, or the amount you owe, when we talk about tax planning, but I'll reiterate the point here that receiving a tax refund or owing taxes isn't necessarily bad or good, and it doesn't reflect whether you or your accountant did a good or bad job preparing your tax return. By the time you file your tax return, what happened with your finances over the prior year has already happened, and your tax liability is what it is. So at that point, there's nothing you can do to impact it, and you're just reporting on what has happened. So keep that in mind when thinking about either the refund you receive or what you owe. And while the tax code is overly complex, the actual tax preparation or filing of your return is often more straightforward than most people realize. It's essentially just a process of reporting what has already happened in your financial life to the IRS and truing up the total amount of taxes you're responsible for in that year. The last part I'll mention when it comes to tax preparation is that you have a lot of different options as to how you handle it. Tax preparation has become more and more of a commodity over the years with the rise of some of the online or DIY tax companies, in addition to technology making it easier to gather the required information. So it's become easier and less expensive to file your taxes yourself. Having said that, we know that even if it was easy and free, there will always be a large percentage of people that don't want to file their own tax return. So an easy solution there is to outsource and pay more money to have an accountant or CPA take on that burden for you. And with all this exciting tax preparation talk, I bet you're chomping at the bit waiting for those 1099s to be released.
Of course. I mean, that can't be the only one, right?
Yeah, I feel like I may just be hitting a low point there with a bad finance joke.
Well, we're both dads, so at least we can justify it.
Fair point.
So now that we explained tax preparation, we'll switch gears and cover tax planning. As mentioned earlier, while tax preparation is backward-looking and reactive, tax planning is forward-looking and proactive. If you think about it like driving a car, tax preparation is looking into the rearview mirror to see what's already happened, while tax planning is looking out the front windshield to see what's coming on the horizon and whether you can do anything in anticipation. So while tax preparation consists of reporting what has already happened to the IRS to figure out your tax liability and whether you'll receive a refund or owe taxes based on what you paid in during the prior year, tax planning is looking at your overall situation and how it's likely to change in the future in order to figure out what can be done proactively to reduce your tax liability or the amount of taxes you'll ultimately pay. And this is a really important distinction to make. While tax preparation simply reports what has already happened and can't change the amount of taxes you pay, tax planning can actually reduce the amount of tax you pay to the government and therefore leave more money in your pocket than you otherwise would have had. And while this can be done on a year-to-year basis, the best tax planning not only looks at the next year, but also looks at a longer time horizon, ideally your entire life, and focuses on what can be done to minimize your lifetime tax bill. We have several podcast episodes specifically dedicated to tax planning strategies, including episode number 3, which focuses on minimizing taxes while you're working, episode number 15, which focuses on minimizing taxes in retirement, and episode number 23, which discusses ways to maximize the tax efficiency of your charitable giving. So we won't go into too much detail here, but just to provide a few concrete examples of tax planning. One would be looking at the retirement savings accounts that are available to you while you're working and how you can reduce your tax liability by contributing to them. Another would be looking at other tax advantage accounts, such as health savings accounts or flexible spending accounts, and whether it makes sense to contribute money to these accounts and receive the accompanying tax deduction. Looking at the retirement period, a big one is being strategic about how you withdraw from your various retirement accounts in order to maximize the tax efficiency of your withdrawals and how you convert your accounts into a retirement paycheck. Another big one in retirement is looking at Roth conversions and whether they make sense to smooth your tax bracket and reduce your total retirement tax bill. There's a lot more we could mention, but the point is that tax planning is all about looking at your unique financial and life situation from a high-level perspective, as well as understanding your goals and what you're trying to accomplish in the future in order to think about what can be done proactively to minimize your tax liability. Another aspect of tax planning, which is less about reducing your taxes and more about making things more smooth and predictable for you, goes back to what Andrew mentioned with tax preparation and how at the end of the process, you find out whether you'll receive a refund or owe taxes based on what your tax liability was for the year compared to what you paid in taxes throughout the year. It's not fun to pay a big tax bill when filing your taxes, so if that's the case for you, either because of your income relative to your life situation and tax filing status, or if you have side income where taxes aren't being withheld throughout the year, one thing you can do is increase the amount of taxes you pay in throughout the following tax year. And this can be done in multiple ways, such as filling out a W-4 to increase the amount of taxes withheld from each paycheck from your employer, or paying in quarterly estimates to the IRS. But regardless of how it's done, this is another example of tax planning where you're proactively looking ahead and planning or adjusting the amount of taxes you pay in throughout the year in order to avoid a negative surprise come tax time.
Yeah, as you can see from some of the examples Trent just went through, there's an important difference between tax preparation and tax planning. And to wrap things up, I'll share some overall perspective and some of the key things to keep in mind here. Knowing there's a big difference between tax preparation and tax planning, you want to make sure you're addressing both, especially because tax planning is the more valuable of the two. And despite this big difference in the two, one of the common misperceptions people have is that if they're paying for tax preparation, they're also receiving tax planning. However, the reality is that most often, the person preparing your tax return is simply delivering the preparation services, but isn't necessarily doing the planning as well. And a big reason for this is that most CPAs or accountants have so many clients that it just isn't possible for them to devote the time and attention to each individual client to reflect on and think through their situation and provide proactive tax planning. If you think about a typical accountant who's charging $500 to $600 to prepare a tax return, you need to prepare a lot of returns in order to make a living. So it often becomes a volume game out of necessity because you need a certain number of clients. Or the accountant will need to charge a higher fee, which may result in paying more for tax preparation and still not result in the optimal tax planning. This isn't discounting the value of an accountant in the slightest or the capabilities for them to be able to handle proactive tax planning, but rather to point out the potential limitations due to the nature of the relationship. Accountants tend to have a great deal of financial information about your situation, But since the relationship tends to be more limited in scope to taxes and tax preparation, they typically won't have a full view of your overall life. This includes both the qualitative and quantitative aspects, such as your goals and what you're looking to accomplish, the specific details of your employer benefits, or your retirement savings plans through work, your plans with college savings, your charitable intentions, how cash flow feels in a given year, or when you'll retire. Or said differently, basically all the details that will allow someone to see the forest, or overall picture, before zooming into the trees, or what you should do in a given year from a tax perspective based on your unique situation. And like I said, this isn't meant to take away the value an accountant or CPA can provide, but because the relationship is usually more limited in scope, it's tougher to have the full big picture view, which is essential for the best tax planning. This isn't necessarily how it works for every accountant or CPA. Yes, there are certain accountants that focus more on the planning aspect and have a more comprehensive relationship with clients, but in the majority of cases, you're paying for and receiving tax preparation rather than tax preparation plus planning. So knowing that tax planning is the more valuable area to address, but also the less common area that people are addressing, it's helpful to understand the ways you can add tax planning to your overall plan. Well, if you're a more DIY personality, the obvious first choice is to do some work or reading on your own and try to get up to speed on the tax planning aspects of personal finance. There are calculators and tools online, forums you can read, and books addressing various strategies to consider based on your stage of life. However, we know most people don't fall into this category, so the other option is outsourcing. Depending on the scope and depth of tax planning you're looking for help with, you can seek out a CPA who is well versed in tax planning and emphasize it as a key part of their services. As mentioned, these CPAs are fewer and further between, and you'll likely pay more for someone who does true tax planning on top of sharing more of the legwork, but it's an easy way to combine tax preparation and tax planning. The other outsourcing option is to look for a financial advisor that covers tax planning as a part of their services that they provide. We might be a little bit biased here, but we think this provides the best option. And the reason why comes down to a couple factors. One, they'll understand the big picture, and two, they'll be able to help you implement any strategies or recommendations. However, we also want to share a word of caution. Looking across the industry, there's unfortunately a large percentage of people who call themselves financial advisors, but ultimately just want to sell products like life insurance or annuities, or focus mainly on investments and don't focus on the full picture and providing financial planning help, which tax planning is a big part of. Having said that, there are still a lot of great advisors out there that provide what we refer to as real financial planning. But you want to make sure you do your homework before blindly assuming your financial advisor is helping you with your tax planning. Which, on that note, we have an entire episode dedicated to helping you do your homework by asking the right questions when interviewing a financial advisor. It's episode number 27, so you're welcome to use that as a resource. And by asking the right questions, you should be able to get a sense of how well-versed an advisor is here.
Yeah, and like Andrew mentioned, we're not trying to make it sound like nobody out there does tax planning, but the main point to make is that most people assume they're receiving tax planning along with paying for tax preparation, when in reality, they're only receiving tax preparation and are missing out on the much more valuable part that actually has the potential to move the needle with your financial situation and allowing you to minimize the taxes you pay. So just make sure you fully understand what you're receiving, and if you aren't receiving good tax planning advice, be sure to seek it out in some form or another. Well, that covers it with our discussion of tax preparation versus tax planning, and just to give a quick recap of the key points we shared. Number one, tax preparation is a reactive process. It's about reporting what happened in your financial life over the prior year to the IRS to figure out how much you owe in taxes for the year, which is known as your tax liability, then comparing that number to what you actually paid in taxes throughout the year to determine whether you'll receive a tax refund or whether you'll have to write a check to the government. Number two, tax planning, on the other hand, is a proactive process. It's about looking at your overall financial situation, your goals, and your expected future path to figure out what you can do proactively to minimize your tax liability, not just in a given year, but more importantly, throughout your entire lifetime. Unlike tax preparation, which doesn't impact your tax liability or how much you ultimately pay in taxes, tax planning does have the potential to reduce your tax liability and leave more money in your pocket. And lastly, number three, just because you have someone preparing your tax return, don't assume they're doing tax planning as well. Due to the nature of the relationship, as well as the typical number of clients, most CPAs or accountants don't have the bandwidth or ability to do true comprehensive tax planning for clients, and more often than not, you're just paying them to prepare your tax return rather than provide true tax planning advice. Well, thank you to everyone for joining us for another episode of the show. You can find the show notes at the podcast page of our website, mdwmllc.com/podcast. We'll be sure to include in there links to some of the prior episodes we mentioned. And if you have thoughts to share or questions you'd like to have answered, please feel free to shoot us an email at info@mdwmllc.com. Take care, everyone, and we'll look forward to talking to you again soon.
Want even more ideas, tools, and resources on how to make smart financial decisions? Check out the resources section of MD Wealth Management's website at mdwmllc.com, where you'll find additional knowledge and insight from Michigan physicians, including a blog, ebook, and one-page guides. While there, you can also schedule a 15-minute conversation with Andrew and Trent to learn more about what it means to work with the firm and how they serve physicians. If you've enjoyed the content, please leave a review on iTunes and share with your friends and colleagues. Thanks so much for listening. Andrew Mushbaugh and Trent DeBruin are certified financial planners, principals, and co-founders of MD Wealth Management, a registered investment advisory firm in the state of Michigan. All opinions shared in the show are for general information and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and no guarantee of future returns. Please consult with your legal advisor, your tax advisor, or your financial advisor before making any decisions.